Wealth Navigation Advisors presents Financial Tides.
Good afternoon, everybody. Welcome to another episode of Financial Tides. This one's called No More T-Bill and Chill. I didn't like the name, I didn't create the name, but Josh and Taylor probably came up with it. But it's called No More T-Bill and Chill. And Wealth Navigation Advisors is happy to be discussing this with you guys today. My partner Taylor and I will go over the transition that's happened over the last few years between short-term interest rates and other opportunities that are out there right now.
Yeah, so kind of just discuss where the idea T-bill and chill came from, because I don't think a lot of the listeners here, some might, but I don't know that 100% of people know what T-bill and chill means.
Okay, so the T-bill, as we know, is a very short-term treasury instrument from the federal government. And what happened over the last couple of years is as the Fed was raising rates to try to dampen inflation, short-term rates went up tremendously and mortgage rates and midterm and long-term rates. But, you could go and get a 6-month T-bill with no state income tax, just federal only, and you can get 5.5%. We got some close to 6% a year or two ago. And so the idea of T-bill and chill was that, hey, I've got all this money that used to be invested longer term. Now I can just roll it into T-bills and just keep rolling those every 6 months, and make 5.5%, 6% with no state income tax on them. So it was the T-bill and chill out and watch and wait for rates to go up even higher.
Yeah, and I think the idea of that came from the old philosophy that was before that, which was TINA, it stands for there is no alternative. Rates were at 0%, so there was nothing you could really do besides buy stocks. Bonds were paying very, very low yields, and you were getting basically no return for owning bonds if you needed income. So the idea was you have to buy stocks for inflation protection anyway. You have to buy dividend paying stocks to create income. So there's really no alternatives, whether you like it or not. You're getting stocks, you're investing in stocks. That's what your portfolio has to kind of be made up on to get the income you need anyway, just because there wasn't an alternative. So then when the interest rate shift happened, the idea started shifting as well that why would you have to deal with the volatility and fluctuation of stocks and have all of that mayhem, which is the chill part? You can get into the no risk or very, very low risk, being it's backed by the federal government, of a treasury bill and still get that 5.5% rate. Why not take a return like that was kind of the idea that everybody had. So they created this trend of sorts called T-bill and chill.
Yeah, catchy, nice, a little jingly. I like it. And I think people forget that when the central banks start these interest rate cuts like they have, that there's a lagging effect. And so the person that thought they were going to ride out, you know, um, T-bills at 5.5% for the next 10 years and not have to have long-term exposure anywhere, it's a big mistake because then they get caught in the trap of having too much liquid money that's now renewing at 1 or 2 or 3%, while inflation is still hot. Inflation's still at 3.5. Some items, the big conversational piece is eggs right now. Some items are still, extreme inflation. So, how do we avoid all this? Is we go back to that bucket approach and say, all right, the T-bill, the 6-month T-bill is okay because you're buying a car in 6 months, or a 6-month CD is okay because you're buying a car in 6 months. But a 6-month T-bill is not a place to keep the money you're going to use in 6 years or 16 years. It needs to be out there in bucket 2 or bucket 3. If it's a long-term goal, we match that asset to a long-term liability.
Yeah, and I think the problem that we're seeing in a lot of clients that aren't already with us and prospective clients and people that we're doing second looks at their portfolio for is a lot of people have ended up in this position where it's a barbell approach, meaning that everything's on two ends. You have the one end of the barbell, which has all your short-term securities, and then you have the other end, which is all long-term, and there's nothing really in the middle to protect that. So we're seeing that a lot with the clients that are out there and people that don't have a fully bucketed approach. And it presents a lot of risk because when the rates come down, they're not going to be getting the yields that they were getting before on the short end, and then everything else is going to be on the long end. And now they have nothing in the middle to protect kind of the more intermediate goals that they're really looking to fund. So I think
I
when
love that example, Taylor, because think about all the calls we got about a year to 14 months ago from people that said, why would I buy a 4 or 5 year treasury at 4.75 when I can get a 6 month at 5.5? And I said, you might win that game on the first 6 month anniversary, but what are you going to do 6 months from now? I'll buy another 6 month. And we're like, if you need the money in 5 years and you don't want stock exposure with that chunk of money, take the 5 year treasury at 4.75 and give up the 3/4 of a point and lock it in. Well, guess what? Today they'd be better off because they'd be a year and a half, 2 years into the 4.75 and the T-bill trade's over. Just like the I bond a couple of years ago was a great deal for about 6 or 8 months, and we jumped all over that for a lot of people. But that trade whittled away, and so you have to be nimble and ready to adjust. And that's why I like the idea that T-bill and chill is over.
Yeah, and I think what you mentioned there is actually a big point of why people are afraid to move out of T-bills still to this day or anything with any level of risk is you spoke of the inverted yield curve. And the inverted yield curve is something that everyone uses as a flag to point to recessions. And what an inverted yield curve is, for those who don't know, it's just a graphical representation of where yields are based on the time period that you're going out. So typically you see that you're going out 5 years instead of 6 months, and you would say, hey, I'm taking more risk for holding something for 5 years. I should get paid more for it. That's the logic, but when the yield curve inverts, it's actually the opposite. You go out 5 years, you're getting paid less on that for holding it for a longer period of time. So that's something that people typically think in the short term is going to point towards a recession. That happened in 2022, I believe, was the year that it actually inverted and stocks took a hit because of it in the short term. But it's still inverted to this day. It's not quite as dramatically inverted. And I think that as we come out of this, the midterm of the yield curve isn't really what's going to move to normalize the curve. It's going to be the short end and the long ends that end up becoming more normalized, meaning short-term rates will continue to keep going down, long-term rates will continue to go up, but the midterm will stay probably about where they are now. So I'm thinking that over the long periods of time, yield curve inverted, there's some more opportunities with that bucketed approach to be outside of just something like T-bills and taking on a little bit of additional levels of risk, knowing you're not going to get rewarded in bonds or longer term treasuries because they're pretty much their rates are probably where they're going to stay right now in the more intermediate area. So we have plenty of ideas that we can give you based on your needs to get out of T-bill and chill, get more intermediate in your investments and have that better protection through a bucketed approach.
Yeah, I'm glad you said that because I've never been more excited about diversification in the last 10 years than I am right now. And, there's like 11 different bond or fixed income asset classes. So everybody wants to talk about, guaranteed government, short term T-bills, but there's corporates, there's high quality corporates, there's high yield, which is a nice way of saying junk bonds. There's municipals, there's high yield municipals. There's so much out there just in the fixed income space. And then on the equity side, there's plenty of dividends out there. We go back to the dividend trade, and out of the 4,000 or so stocks that trade out there, I think like 1,000 of them are positive over the last couple of years, and the rest of them are flat or negative or close to flat. And so what that's saying is when everybody's turning around and saying the market's overpriced, ask XYZ company that's price is where it was 4 years ago. And all they did was raise their dividend 3 years in a row. But their price just hasn't been rewarded yet. And so there's opportunities. And again, those opportunities, those stocks, they go in our long-term bucket. And back to the fixed income side, we think there's a ton of alternatives to the T-bill trade that on a case by case basis. If you're not paying any income taxes, we don't need to talk about municipal bonds. If it's an IRA only, we don't need to talk about municipal bonds. But if you're living on a large portfolio draw from a large asset base, tax-free bonds are very valid, and a lot of them are well-rated, water authorities and school districts around the country.
Yeah, and I think the important thing to understand is coming out of this when we're talking about the fixed income space is, again, locking in rates. You don't need to be in a short-term investment vehicle for money that's not short-term. You want to lock in rates now before rates come down, because in order for that yield curve to normalize, you need to take some additional risk in either duration or in short-term duration. Rates are going to go down, so you want to lock in a rate that will be there and that for a longer period of time. You don't want anything that's callable, because we know we're in a situation now where the only direction the Fed can really go is by cutting. I don't think anyone's talking about another rate hike. It's just a matter of when the next rate cut is going to be. So we know they're going down, so lock in those yields while you can on the fixed income side.
Excellent. Well, I thank everybody for joining today. And if you have any questions, we're available at any time. I think Josh is going to post our signature or phone number at the end of this for people to copy that information down. Feel free to forward this to anyone if you have a digital copy. It's not something we feel is client only. It's out there on the web somewhere too. So have a great day. Thanks for joining us, and look forward to speaking to you next time.
Yeah, we appreciate you guys listening. We think that T-bill and chill is, if not dead yet, fading away. So time to make your plans and get ahead of it now. So thanks for listening to Financial Tides. We'll see you next time.
John Perillo and Taylor Perillo are financial advisors offering securities through Cetera Advisors LLC, a registered broker-dealer, doing insurance business in California as CFGA Insurance Agency LLC, member FINRA/SIPC. Advisory services offered through Cetera Investment Advisors LLC, a registered investment advisor. Cetera firms are under separate ownerships from any other named entity. California insurance licenses number 0F60123 and 0M90666, 6265 Greenwich Drive, Suite 251, San Diego, California 92122. The views depicted in this material are for information purposes only and are not necessarily those of Cetera Advisors LLC. They should not be considered specific advice or recommendations for any individual. Neither Cetera Advisors LLC nor any of its representatives may give legal or tax advice.